I used to be the kind of trader who lived and died by the news. Every Fed meeting, I sat and waited. Every CPI release, my body tensed as if stepping into a fight. And whenever NFP came out better than expected, I didn't hesitate. I entered the trade. But then, price moved in a direction completely different from what I believed was right. There were times when good news was released, yet the USD dropped sharply. Times when bad news appeared and gold kept climbing higher. I began to lose my bearings. I doubted. I grew frustrated. And worse than that, I slowly started to believe the market was deliberately working against me. I blamed the market. I blamed the news. I blamed everything, except one thing: myself. I remember clearly there was a week when I lost 4 trades in a row. Not because the strategy was wrong, not because I lacked knowledge, but because I placed too much faith in news and numbers. I believed that good news meant price had to rise. I believed that bad news meant price had to fall. I believed the market operated like a rational machine, but it doesn't. The market is emotion, it is reaction, it is expectation, and above all, it is the breaking of expectations. A mentor once said to me, "Don't trade the news, trade how the market reacts to the news." At the time, I didn't understand, but each losing trade, each time price moved against me, each sleepless night taught me one thing: what matters is not what happened, but what did not happen. From there, I began to learn a principle that only those who survive long enough in the market truly absorb. Only trade when the news is good, but price does not rise. Only enter when the news is bad, but price does not fall. When the market reacts against expectation, that is the moment truth reveals itself, and that is when I act. I lost a great deal of money simply because I trusted what I believed was logical. Good news was released, I bought. Bad news appeared, I sold. I did everything the textbooks, financial channels, and analysis groups said was correct, yet the result was still loss. Because I forgot one crucial thing: the market does not operate on theory, it operates on money flow, and money flow always moves ahead of the crowd's logic. There were times I did nothing but sit and watch the chart, placing no trades at all, just to see whether price would react the way the news suggested it should. And that's when I began to notice things I had never seen before. Extremely good news, price stood still. Extremely bad news, price refused to fall. There were times when no news had been released at all, yet price had already moved a full day in advance. I realized then that the market waits for no one, and it certainly does not wait for those who believe price will move according to what they want. From that point on, I stopped chasing price. I stopped chasing news. I chose instead to follow the footprints of money flow. And to do that, I had to become a different kind of person. Someone who does not react with the crowd. Someone patient enough to wait for the market to betray its own expectations before acting. I created the Quiet Trading channel not to stand on a podium and teach trading. I created it to tell real stories of falling down. Lessons paid for with months of loss and long stretches of silence. This is not a place for those who want to get rich quickly. It is a place for those who want to stay clear-headed long enough. If you have ever traded and felt the market slap you straight in the face, if you have ever believed you were right until the market proved otherwise, then perhaps it is time you needed a place to look at the market differently. Quiet Trading is not a channel that showcases skill. It is a journey of mindset, a place where you don't learn more indicators, but learn to turn back and look at yourself. And if you are ready to let go of your illusions, keep walking with me. The sound of the clock ticks softly, one beat at a time. So quiet it feels as if time itself has been stretched. March, a Friday evening. The NFP report is about to be released. I no longer sit waiting in front of the screen like I once did. I sit farther back, a cup of coffee in my hand. And my eyes are no longer fixed on price, but turned inward, observing myself. At that moment, every signal is clear. The US economy has just exceeded expectations. Employment has risen sharply. The labor market looks bright, just as CNBC says. The USD is forecast to continue rising. Gold is almost certain to break down. And the initial scenario unfolds exactly that way. In the first minute after the release, gold drops hard. USD JPY shoots up as if driven by an engine. Analysis channels unanimously call it a chance to buy USD, but I do nothing. I only watch. By the 5th minute, price begins to stall. By the 10th, USD no longer advances. By the 15th, gold slowly starts to recover. I sense a strange silence on the chart, not because buying or selling pressure is absent, but because large money doesn't want to push price any further. I don't need a single additional indicator. I don't need any more analysis. I can see it clearly. The market is refusing to do what it is supposed to.
Exceptionally good news, yet the USD does not rise any further. In that moment, everything in me closes into a single thought. This USD sell is not just a trade, it is an ambush. I enter the position. Short USD JPY. Stop loss set tight. No grand expectations. I only need the market to confirm one thing, that it is truly betraying the crowd's expectation. 1 hour later, the USD begins to drift lower. Not aggressively, but enough to unsettle the FOMO traders. 3 hours later, gold has returned to its previous high. USD JPY is down 70 pips. I close the trade. No need to hold any longer. It wasn't my biggest trade, nor was the profit something that thrilled me, but it was the first time I truly won a trade because of price's silence. Not because I was fast, not because I was better than anyone else, simply because I knew how to wait. And I understood that when the market refuses to do what it is supposed to do, it is preparing to do something very few are willing to believe. After that trade, the way I looked at charts changed. I stopped hunting for entries. I started looking for moments when the market becomes absurd. Absurd is when the news is extremely good, yet price does not rise. When the news is extremely bad, yet price does not fall. When the news is ambiguous, but price moves as if it already knows the outcome. I call that expectation distortion. And it is precisely in these distortions that the market reveals its true secrets. The market does not care about what happens. It cares about how many people are expecting it to happen. And when everyone expects the same direction, the market will not go that way, because there is no one left to push price further. For example, NFP comes out beautifully. Everyone buys USD before the release. The data prints exactly as expected. There are no new buyers left. Price stalls, then turns. Simple, cold, extremely effective. That is how long-term traders survive. They don't need to be right about the news. They only need to be right at the moment when the crowd's conviction begins to crack. They trade when the market is overflowing with optimism but cannot rise, or drowning in pessimism but cannot fall. And it is at that boundary that those who remain and those who leave the game begin to diverge. You don't need to know what will happen. You only need to know whose expectations the market is preparing to break. And when you learn to hear the market speak through silence, you have stepped into another layer. People call it intuition, but to me, it is simply listening to what price does not say, yet still reveals through its refusal to react. From that point on, I no longer needed to trade often. I needed only one move, at the exact moment expectations were betrayed, when silence became the market's loudest scream. I began to see a rule repeat itself over and over. The right time to trade is not when the news appears, but when the market's reaction deviates from the script already drawn. That is when the game truly begins. Expectation destroys more accounts than spreads, leverage, or impulsive emotion ever could. And the most dangerous expectations are the ones shared by too many people. The crowd is not wrong because it lacks knowledge. The crowd is wrong because it believes in something too obvious. And when everyone believes the same thing, that belief loses its power. They believe lower CPI means gold must rise. They believe high interest rates mean a stronger USD. They believe tension between Israel and Palestine means oil must climb. And then price stalls. Sometimes it even turns the other way. Not because the news is weak, but because every trade based on that news was already placed before the release. When price does not rise after good news, it does not mean the market is weak. It means buyers have already done their job. There is no fuel left behind them. And when buyers are gone, who steps in next? No one. Only those who begin to step away. And when price starts to wobble, the second, the third, then dozens more abandon their positions. At that point, it is no longer a reaction. It becomes a domino effect of emotion, where each pip is no longer just money, but a reflection of a crowd losing its sense of direction. The best traders do not measure pips. They measure emotion. They do not measure the strength of the news. They measure how much the market doubts that very news. They wait until the market no longer believes, and only then do they enter. It sounds paradoxical, but trading has always been full of paradoxes, and you only win when you dare to go against them. I lost a great deal of money to learn this, but once I learned to hear the market through its silence, I no longer needed to win every day. I only needed to be right at the moment the majority was wrong, before they even realized it themselves. And you can begin learning this way too, without paying the thousands of dollars I once paid. You only need to set your expectations aside and look at the market as if you believe in nothing at all, because it is precisely when you stop believing that you begin to see. See more clearly than all those still blinded by their beliefs. Most traders enter the market with a familiar question. The news is coming. Should I buy or sell? But seasoned traders ask a different question, a simpler one, yet far deeper. What is the crowd expecting? And what happens if the market does not do that? That question is the starting point of an entirely different way of thinking, not predicting in advance, but waiting for the reaction afterwards.
This is not gambling. It is observing misalignment. And so you can bring this way of thinking into real trading, I will share an action framework in 4 steps. Each step is drawn from real experience, with concrete examples, so you don't just understand it, but can apply it in the days ahead. Step 1. Identify the crowd's expectation. Before any major release, inflation, interest rates, non-farm payrolls, or geopolitical news, the first thing you need to do is not open the chart, but open your awareness. Ask yourself, what news is coming? What is the market waiting for? What are the major outlets saying? What about analysis groups? What are financial experts repeating? Suppose the US is releasing CPI tomorrow. You read Bloomberg and see that most forecasts expect CPI to fall. That leads the crowd to believe the Fed will slow down, the USD will weaken, and gold will rise. That is the market's shared expectation. Your task is to see that belief, not to adopt it, but to doubt it. If CPI comes out exactly as expected, will price still keep moving? Or has most of the positioning already happened? Step 2. Do not enter immediately after the release. Observe. The moment the news is released is when emotion peaks. Price can spike tens of pips, even hundreds within seconds. But you don't. You follow money flow, not the first impulse wave. You wait. Suppose CPI prints as forecast, lower than the previous reading. Right after the release, gold jumps about 30 pips. USD JPY drops 15 pips. The crowd cheers. See, I told you, the Fed will be more dovish. But you still do nothing. You wait through the first 5 to 15 minutes to observe what comes next. And if after the initial spike, price begins to stall or even turn back,
That is the first signal. Price is not continuing higher despite good news. Buying pressure is weakening. This suggests the market may have already reacted and is preparing to move in the opposite direction. Step 3. Look for confirmation in price action and volume. You don't need 10 indicators, you just need to look. Are there long wicks? Reversal patterns? Does volume increase while price fails to extend? For example, after gold rises 30 pips on CPI, you see a candle with a deep lower wick. Then a bearish pin bar. Volume increases, but price cannot break the newly formed high. You understand what is happening. Someone who is not a retail trader is selling while the crowd is still buying. Large money does not chase the news, they use news as a trap. Wait for the crowd to fully believe, then move the other way. Step 4. Enter with asymmetric thinking. Only now do you act. But unlike emotional entries, you enter because you've identified misalignment, and you act with a probabilistic mindset. You don't need a 200 pip move, you only need a reasonable risk-reward. For example, 20 pips of risk, 60 pips of target. Your trade doesn't need to be complex. Enter after reversal confirmation. Place the stop loss just beyond the rejected high or low. Set take profit near a previous price area or manage the trade as the market unfolds. What you need is not a single massive winning trade, but one trade that goes against the crowd at the exact moment they have just lost their sense of direction. After applying this system around 10 times, you will begin to notice something clearly. You no longer panic when news breaks. You no longer enter trades simply because price is moving. You begin to know how to stop, how to wait. And when the market refuses to do what it is supposed to do, you understand that this is precisely when you act. This 4-step framework is not a magical formula. It does not guarantee a win in every trade, but it helps you do something that 95% of traders out there cannot. To trade with conscious reaction. Not chasing the market, but waiting for the market to reveal the truth. And once you train that reaction long enough, you no longer need anyone to analyze for you. You only need a single candle, a single misaligned reaction, and you immediately know that right there the crowd is wrong and you are right. Not because you're better, but because you are more patient. There was a long period when I almost dared not open the charts at all. Not because the market was too difficult, but because I no longer believed in the beliefs I once clung to. I used to think trading more made you better. I used to think the best analyst would always win. I used to think trading was a game of knowledge. Learn enough and losses would disappear. But that is not the truth. Trading is a journey where you strip away layers of illusion and face yourself every day. You don't lose because you lack knowledge. You lose because you trust the market too quickly and doubt yourself too slowly. I'm not sharing this video to appear profound. I only want you to understand one thing. When good news comes and price does not rise, when bad news comes and price does not fall, the market is whispering something to you. Most people simply aren't patient enough to listen all the way through. If you are still here, I believe you are not just trying to learn how to trade. You are trying to learn how to survive. And to survive with dignity, with understanding, with a system. I created Quiet Trading not to teach you how to get rich quickly. I only want to open a path for those who have silently endured long nights holding positions that no one else could understand. Thank you for listening. This is Quiet Trading, a place for those who no longer believe in miracles, but begin to train the purest kind of reaction. To look into the market's silence and act while the crowd is still hesitating.